Whenever a big financial crisis hits, it feels totally unique, right? A once-in-a-lifetime catastrophe. The Great Depression, the dot-com bust, 2008, the COVID crash, they all seem to have their own story, their own villains. But what if they're not so unique? What if, underneath all the noise, Wall Street's biggest meltdowns are just playing out the same old script of human behavior, greed, and fear? Today, we're pulling that script apart to see how it works.
So that's the big question we're tackling. Do these massive economic earthquakes actually follow a predictable script? We're going to dig into the boom and bust cycle, not as a bunch of random historical accidents, but as a recurring pattern, a pattern that holds some pretty crucial lessons for any investor trying to navigate the markets today.
All right, so here's how we're going to break it down. We're starting with the granddaddy of them all, the blueprint, the Great Depression. Then we'll look at the 1973 oil crisis, which was all about external shock. After that, the mind-bending complexity of the 2008 meltdown, and of course the insane speed of the COVID crash. And stick around, because at the end, we're going to tie it all together into a modern playbook for you.
First up, the original blueprint for a total financial collapse. The Great Depression wasn't just a stock market crash. No, it was a complete societal breakdown that basically wrote the playbook for speculation, leverage, and panic. Patterns we've seen echoed in every single crisis since.
Okay, so before the crash, there was the party. And what a party it was. The Roaring '20s were this incredible boom time. It honestly seemed like the laws of gravity just didn't apply to the stock market. Everybody, and I mean everybody, wanted in. From Wall Street moguls to regular folks taking their life savings and piling into stocks, absolutely convinced they could only go up. And the banks, they were fueling the fire, handing out credit like candy so people could borrow even more money to buy more stocks. The optimism was everywhere, but it was just a mask for a foundation that was dangerously unstable.
And this quote just hits the nail on the head. The market wasn't some solid, well-built structure. It was a fragile house of cards, built on borrowed money and blind faith, not on real value. The entire game depended on prices continuing to rise. As long as they did, the party kept going. But as we all know, a house of cards is always, always just one stiff breeze away from falling apart completely.
And then, bang. Black Tuesday, October 29th, 1929. That breeze arrived, and it was a hurricane. The market didn't just dip, it vaporized. Entire fortunes disappeared in a matter of hours. And that set off this absolutely devastating domino effect. Banks went under, businesses just crumbled, and the crisis suffocated the entire global economy. It's crazy to think it took the sheer industrial power of World War II to finally drag the world out of that hole. And look, this is why it matters. This wasn't just about numbers on a stock ticker. It was about people. This number, 25%, that was the peak unemployment rate in the U.S. Think about that. 1 out of every 4 people who wanted a job couldn't find one. You had breadlines stretching for blocks. It was a period of incredible human suffering, and it left this deep, deep scar on a generation. Okay, for our next case study, the script gets a major twist. The 1973 oil crisis wasn't born from people speculating on Wall Street. Nope, this crisis came from an external geopolitical shock. This time the weapon was silent, but absolutely devastating, and it proved that sometimes the biggest threat to your portfolio comes from way outside the stock exchange. And here's what that weapon looked like in practice. In October of '73, OPEC, the Organization of Arab Petroleum Exporting Countries, slapped an oil embargo on countries that had supported Israel during the Yom Kippur War. The effect was immediate, and it was catastrophic. I mean, look at this. Oil prices didn't just go up a little bit, they quadrupled. They jumped from about $3 a barrel to 12. For the entire industrialized world, which was built on cheap oil, this was like someone just cut off the oxygen supply. This oil shock didn't just cause gas lines. It created a whole new economic monster, something we call stagflation. And economists at the time were totally baffled. For decades, the standard thinking was that you couldn't have high inflation and high unemployment at the same time. One went up, the other went down. But now the world was staring down this devastating combo, and all the old economic tools, they were useless.
So let's just be clear about why this was such a nightmare. First, you have stagnant growth, so the economy isn't really going anywhere. Then you have high unemployment, so people are losing their jobs. And to top it all off, you have runaway inflation, which means every dollar you do have is worth less and less every single day. The cost of everything just exploded. It was a crisis that hit everyone, from big companies to families just trying to buy groceries.
Now, let's jump forward to a crisis that felt terrifyingly familiar, but was also dangerously new. The 2008 global financial crisis was, in a lot of ways, just the 1929 blueprint all over again.
Speculation, easy credit, this crazy belief that prices can only go up. But this time, the whole system was jacked up on steroids, supercharged by this insane complexity and a total failure of anyone to keep an eye on things.
So how exactly did Wall Street build this financial bomb? Well, it's a 4-step recipe for disaster. Step 1, lenders started handing out risky subprime mortgages to basically anyone with a pulse. Step 2, Wall Street took thousands of these loans and bundled them together into these ridiculously complex products. The best analogy is a financial lasagna. You've got some good layers mixed in with a lot of hidden, really bad layers. Step 3, and this is the crucial part, they got the rating agencies to stamp the whole dish with a perfect AAA rating. And step 4, they sold these ticking time bombs to investors all over the world, spreading the poison throughout the entire global financial system.
And for a while, this whole crazy system actually worked, as long as housing prices kept going up. But once the housing market finally peaked and started to fall, people started defaulting on those loans. The time bomb started ticking faster and faster. Then September 2008 hit, and the whole thing just blew up. The collapse of Lehman Brothers, a giant on Wall Street, sent a shockwave of pure panic through the markets. The system froze solid. The credit that keeps our entire economy moving just vanished.
I mean, the fallout was just huge, and it needed a huge response. This number, $700 billion, was just the initial price tag for the TARP bailout in the U.S. It was this massive government intervention to pump money into the banks just to keep the whole system from collapsing entirely. But for millions of people who lost their homes, their jobs, their savings, the damage was already done.
And that brings us to our last case study, the most recent, and honestly, the most bizarre. The COVID crash in 2020 was different. A new variable got thrown into the crisis script: pure, mind-blowing speed. This was a crisis where both the crash and the recovery happened at warp speed.
Think back to the start of 2020. Markets were flying high, hitting all-time records. Then, this virus goes global. Wall Street started to panic in March, and it triggered a chain reaction of historic collapses. It started on March 9th, Black Monday, when the Dow just plunged, tripping circuit breakers designed to halt trading.
Just 3 days later, it happened again. Black Thursday. Markets fell off a cliff as the world started to lock down. The selling was just relentless. You could feel the fear. And then, unbelievably, on March 16th, we had another Black Monday. The Dow dropped almost 13% in a single day. In just a few weeks, the market had absolutely disintegrated at a speed nobody had ever seen before. All of it amplified by high-speed algorithms and the 24/7 news cycle.
But then something totally wild happened. Fueled by massive government stimulus checks and a whole lot of optimism about tech companies, the market staged a V-shaped recovery that was just as fast as the crash. By August, the S&P 500 was back to where it started. And this just perfectly shows the great disconnect. You've got Wall Street celebrating the shortest bear market in history, while Main Street was dealing with immense pain. Businesses gone forever, unemployment through the roof. It really exposed this deep divide between the financial markets and the real economy. Okay, so after walking through all that chaos, speculation, shock, complexity, speed, what's the takeaway? What have we actually learned? Now let's try to translate all that history into a clear, actionable playbook for you as an investor trying to make sense of all this.
Let's boil it all down. From the Great Depression, the lesson is, be skeptical when everyone around you is euphoric and getting into debt seems easy. It's usually a sign that major risks are being ignored. The oil crisis is a reminder that your portfolio isn't an island. A geopolitical shock halfway around the world can wreck your investments. 2008 gives us a blunt rule. If you can't explain an investment simply, just stay away. Complexity is almost always used to hide risk. And finally, COVID proved that the stock market is not the economy. Just because stocks are soaring doesn't mean everything is fine.
So what's the bottom line here? Well, the triggers are always different. Stocks, oil, housing, a virus. The patterns of human behavior are remarkably consistent. Optimism turns into greed, greed turns into fear, and fear turns into outright panic. History doesn't repeat itself perfectly, no, but it sure does rhyme. We've been shown the script time and time again. The real question left for us is, what's going to trigger the next one? And have we learned anything at all from the last?